There we are. Hi, Hoppy.
Good morning.
Hello, and there's Dee Dee. Wonderful. And we have Leonard too, I hope. So thank you. Thank you so much. I'd like to welcome our first bank presentation, which is following on the consolidation theme that Mike was talking about. First Bank Shares acquired Heritage Southeast, ticker HSBI, where I know several shareholders of HSBI, including us, we're delighted. We're absolutely delighted by this transaction. So thank you. Thank you for all the value that you've been creating in the space. We wanted to take this opportunity to get to know First Bank Shares better because it's an all stock consideration. And so we'll be shareholders of your bank soon. And plus I know we have shareholders of your bank currently on as well. So if you could, I'd like to introduce Hoppy Cole, the CEO, Dee Dee Lowry, the CFO, and I believe Leonard might be joining us as well from Heritage Southeast. So thank you, each of you. Please, I'm ready to go with the slides.
Well, good morning, everyone, and Julianne, thanks so much for the invitation to present. We're always excited to talk about our company. As Julianne mentioned, I am Hoppy Cole, CEO and President of First Bank Shares. And the First Bank, we have with us Dee Dee Lowry, who is our CFO, and Leonard Moreland, who currently, as you guys know, is the CEO of Heritage Southeast Bank, but will be joining our team upon the closing of the pending merger application to be part of our executive management team. Our company will talk a little bit in our presentation today about an overview of our company, how we got to where we are, what we think the upcoming merger creates, continuing with the theme of value creation that Julianne talked about earlier, and then what we think we can create in the Southeast upon the consummation of this merger and the growth trajectory that it provides our combined banks. So we were founded in 1996, 26 years ago. The current board is composed of 12 members. 8 of us were original founders that went around and knocked on folks' door in Hattiesburg, Mississippi, and said, "Good, we think it'd be a great time to start a bank. Please buy 100 shares of stock in our bank." And so we raised about $6.5 million of capital in Hattiesburg and began what was known then as the First National Bank of South Mississippi. Over the years, we've grown that initial capital investment into the 4th largest bank headquartered in the state. We currently are $6.7 billion in assets pro forma. You'll see a footnote there as of June 30th. Plus the closing of an acquisition on July 31st of Beach Bank, which was a bank headquartered in Fort Walton, Florida, that had 6 branches in Northwest Florida and 1 in Tampa, Florida. So together today, we're a little over 6.5, close to $6.7 billion. We have 97 locations throughout the Southeast and a market share that's fairly evenly distributed between states. And we'll look at a slide in a minute. And not only are we widely diversified and geographically distributed, but we have meaningful market share in most all of our markets, and that's important to us. And then we have been a high-performing company. We run an efficiency ratio below 60%, 58.3%, and we're extremely well capitalized with a little over 18% total risk-based capital, and our returns have been on the higher end of our peer groups with a 136 pre-tax pre-provision ROA. We have done a number of transactions since really our strategic vision in 2009. We've closed 14 transactions, and the HSB transaction will be the 15th transaction in those number of years. So, Julianne, if you would turn the page, please, ma'am. And so how did we get here? And so 2009, our group of directors were sitting around the board table in Hattiesburg, and we said, gosh, we're $500 million. We have 9 branches. We were listed on NASDAQ and we traded on some FBMS. We had upgraded our listing to the NASDAQ capital markets, which has now become global, but we traded 500 shares a day, traded about 80% of book value and about $7.50 a share. And so we get, gosh, we've got to grow our franchise to create value since we own most of it at this point. And so we continue to have a meaningful stake in our company, even though we've grown the market cap substantially. We'll talk about that in a minute. But we drew a box and said, look, we're going to have to grow our franchise into markets that provide better overall growth demographics in terms of population and income perspectives in order to generate a premium valuation to create value for our shareholders. So it's been a combination of an organic and acquisitive strategy over those years. And we've grown our assets a compound basis, 25% a year. And so on the left, you see where we started with 9 branches. And today, with 94 branches and 3 LPOs, we built a market share across the Southeast with exposures to some of the very best markets, not only in the Southeast, but in the country. If you look at the chart below that, it's been a combination, as we talked about, of acquisitive, but also organic growth. And people think of us as, you know, it seems like a negative term, serial acquirer, but we do, and we remain nimble. We always look for opportunities to acquire other institutions that grow our business. And in the short run, that can be very profitable by making those companies efficient. But in the long run, we do that in order to generate organic growth and have top line revenue growth to generate superior valuations. So we don't lose sight of the fact that it is really a two-pronged strategy. So Julianne, next page, please, ma'am. I threw this chart in real quick just to give you an indication of what this strategy over this 12-year period since we had the vision of creating a high-performing Southeastern community bank franchise, what that's meant to our shareholders. And I know in the last presentation, I caught the end about being shareholder-driven, and you know, insiders still own 10 to 15%, I believe, of this company. So we are shareholders, and we're very focused on those shareholders' returns. So, you know, over the last 10 years, our stock has grown from $9.21 to, at the end of the second quarter, $31 a share. We've grown the value of our shareholders' investment. Our market cap now is approaching, really, with the combination of HSBI, will approach almost $900 million in market cap. We've created substantial liquidity for our shareholders, trading, you know, only a few thousand shares a day to over 73,000 shares a day. And I want to, you know, throw this out there. If you look in terms of valuations, we think it's an extremely nice entry point based on historically where we have traded in terms of multiple earnings and multiple tangible book. But then hopefully after we talk about what we think we can create, we think it's an outstanding time to own FBMS. So Julianne, real quick, how do we look relative to peers? Well, you'll notice we're 42, and now our peer group that we measure ourselves against is all publicly traded banks in the Southeast with assets between 1 and 10 billion. And if you look at in terms of TCE, we're 42 basis points lower than peers. That has a lot to do with the liquidity and that we've created, and that will be quite an advantage in this environment. We'll talk about that in a minute. But we have an outsized investment portfolio relative to percentage of assets. Now, it's a short-term portfolio. We've constructed it, and really the market is coming to us because of its short-term nature. It's going to provide us a lot of ability to remix the balance sheet, and we think materially enhance earnings. Below that, you'll see as sort of contingent or that supports that is we're a 58.9% loan deposit ratio at the end of the second quarter. So we're able to generate the returns that we've talked about with a relatively low leverage, operating leverage in the company. And so again, given the interest rate environment, given the growth trajectory we're going to talk about, we've got an awful lot of liquidity to deploy, which will simply only enhance those returns without substantially having to take on a lot of risk and without having to materially grow the balance sheet anymore. Simply remixing the balance sheet is going to provide a great ramp in terms of earnings accretion. Again, we concentrate on obviously being an efficient expense management, an efficient company. We're 176 basis points lower than peers. And that's an interesting concept because we also are the combination of a bunch of small, relatively rural, although we have some exposures to some nice markets, community banks. And so when you think about that, we're not taking large exposures, and we don't have the density of assets necessarily per branch that some other banks might have in some larger markets, yet our returns today compare with theirs, yet we continue to be, without taking maybe as much risk, without taking large exposures in any niche businesses, we continue to be an efficient company and generate high returns. And then again, we have a well-diversified core deposit franchise, retail-oriented across the Southeast, very low betas, and a little 5.5, almost 6% higher in terms of core funding than our peers. Julianne, please, ma'am. If I'm going fast, I apologize because I want to make sure I try to get through it. I know we won't have some time for questions. So I heard Mr. Godby at the end talk about being shareholder focused. Again, we are shareholders. We think we have a number, and we have demonstrated we have a number of tools in our belt to reward our shareholders for their support. We have been a consistent tangible book value grower, even though we have done a number of transactions. and taking, in some cases of what we determine minimal dilution, but the growth trajectory and the earnings accretion has more than outweighed the initial dilution that we've taken, with the exception of the interest rate, the AOCI marks this year, again, which were a little bit outsized for us because of the percentage of the investment portfolio to assets, not the construct of it. We also, and share, if you look, one of the tools we have in our tool belt are share repurchases. Again, we stand ready to improve the value, return, compensate our shareholders when we think the opportunity is there. So we have over time bought back shares, and we've had to manage that in light of the fact that we want to make sure we've got ample capital to continue the growth rate and continue to deploy it and grow our franchise. But when the opportunity presents itself, we absolutely will repurchase the shares if we think that is a value proposition that makes sense. We've been a consistent dividend increaser since we got our earnings. We built our earnings up and earnings ramp. That's important to us and to our board, and to, again, continue to compensate our shareholders in that regard. We have a relatively low payout ratio relative to those peers. Our earnings continue to ramp, and it is our intention to continue to increase our dividend, again, to reward our shareholders. And so finally, there's a graph at the bottom. And what has that meant to you if you're a shareholder in terms of, since 2016 all the way to the first quarter of, really, second quarter of 2022, graph breaks down the cash that we've returned to our shareholders plus the dividend. So I want you to, it is forefront. We are shareholders, and we think that way. We absolutely look to reward our shareholders for their support. So Julianne, next page, please, ma'am. Real quick, and this is just a little bit of our franchise, but I guess what I want to point out here is that we have had over those years relatively pristine credit. We have had a strong conservative approach to credit. Our numbers have borne that out. And much like our deposit portfolio, we don't take large concentrations in terms of any one collateral code, any one industry, or any one geographic consideration. We manage to all those concentrations, and we look very closely to make sure our capital is not overexposed. If you look at our CRE concentrations, we're currently in the construction book, we're about 65% of capital, and overall we're about 106. If you include income producing CRE, about 175% of total capital. So we watch it closely, and given the capitalization, we've got plenty of room to continue to do what we do in the Southeast, which is primarily real estate oriented and CRE oriented. So next page, please, ma'am. Real quick, asset quality over time, and you can just kind of see some of the trends here. All have been extremely good for our part of the world. We continue to look at it very closely. We continue to monitor it very closely. I tell people all the time that a conservative credit nature helps me sleep at night. And so even as we enter into some larger markets that provide larger potential growth prospects, continuing the culture of relatively conservative credit and staying within policy guidelines is really paramount to our company. So Julianne, next page, please, ma'am. And again, just real quick, what have our charge-offs looked like relative to the banking industry? Was substantially less than the banking industry over, since 2005. I would note, though, the company looks much different today than it did in 2005. So that's not lost upon us that, again, we've had a prudent credit culture. We've deployed that prudent credit culture throughout the Southeast, but I would, I would proffer to you that the portfolio may be in fact less risky than it was in 2005 or 6, because it is much more diversified across geography, industry type, collateral code type, whereas in 2005 it was all concentrated in South Mississippi in a relatively few number of industries. So we really believe that the diversification and growth that we've experienced have reduced the risk in our portfolio, particularly concentration risk. So Julianne, next page, please, ma'am. So that's where our company was, or where we are. And so I wanted to talk a little bit about Heritage Southeast Bancorp. And you mentioned that a number of the shareholders here were thrilled about this transaction. We are absolutely thrilled. And this started in January of 2021. Leonard and I met in Atlanta and began to form a relationship about our banks. And then all of a sudden, there was a transaction announced with the credit union. And so we were very disappointed in that. In fact, I think we described it as crying in our beer in Hattiesburg for a short while. But we did stay in touch, and we were excited to get the opportunity to come back and be able to partner, because we felt very strongly from my first meeting with Leonard, we really do. And I know a lot of people talk about it, but it is amazing how much culturally we are alike, not just in terms of business model, how we think about credit. It's how we interact with our employees and spending time with, and with each other, by the way. So I'm very much looking forward to Leonard and the team joining our company, and we're really excited about what we can create. I know most of you know this, or a lot of you know this, but Heritage Southeast has 23 branches. They're headquartered in Atlanta. They have 9 branches in and around Atlanta with significant market share. They're about, I believe, about 3/4 or 2/3 of the bank is headquartered. Market share is in Atlanta, and then they have exposure and meaningful market share in some very nice high growth markets in Southeast Georgia, starting in Savannah, all the way down the Georgia coast and ending up in Jacksonville. And so, as I mentioned earlier, that footprint ties extremely well to what we did in the transaction we closed with Beach Bank earlier in the year, where we opened up the Central Florida market in sort of Tampa, St. Pete, with a team that really understands and has that a lot of roots in the Central Florida market, and it ties it together perfectly in order to grow that market out all the way up through Georgia and the prospects to Atlanta that provides us. And so when we talk about this is really an inflection point in the growth trajectory of our company, we've spent all these years building this market share across the Southeast, which is stable, low cost.
I apologize.
Stable and low cost. And we had some nice growth markets, but most of the markets we were in and around before these transactions provided us with like 5 to 8% asset growth per year, which is a nice organic growth rate. But this really accelerates with the markets we think in Atlanta, Southeast Georgia, and certainly Central Florida. Those we think will provide double-digit type growth opportunities as we move forward. So Heritage Southeast was a $1.7 billion bank, well-run, as you guys know, well-managed, a 1.04 ROA, a 15.6% return on tangible common, and a nice margin at 331. So next slide, please, ma'am. I hope I'm not going too fast, Juliana.
Oh, no, that's okay.
Good. Transaction rationale, we think about things and in 3 of the major points, like most acquirers, hey, what's the strategic rationale for this transaction? Financially, how does it impact our shareholders, and what sort of risk does it create? So strategic rationale, we've talked a lot about it, but entry into new high growth markets with a company that shares a common culture, a common funding base, and really the most important part of this, and we've done this a long time, and I say this, the math on the page and the structure of the financial details of the transaction, it is the easier part to do. The secret to making these transactions work is, number one, to have a common culture, to really truly share a vision, so that with the acquiring institute or with the target institution, such that if we can't work together and we can't get the folks to buy into what our strategic vision is, it's not going to work. And you've seen that in a number of instances around the country when they try to put 2 banks together who were culturally and business model very different. Here, we feel strongly that Leonard and the management team at Heritage Southeast fit perfectly with what we've tried to create as a culture. And when people ask us, and they've asked me for a number of years, describe your culture, it's very simple to us. There is an expectation of performance at first within a culture of compliance. We have that expectation of performance, and quite honestly, in a number of the small banks that we've bought, particularly smaller family-owned banks that didn't necessarily share that performance expectation, those folks have a harder time adjusting to our business model. But if you are a performer, and look, you guys, I don't have to tell you, Heritage Southeast is full of performers. They do very well in our business model because we are able to provide capacity, structure, pricing structure, competitiveness with almost anybody in the markets that we operate in. And our system is more nimble than a super regional or a regional bank, and that we still retain a decentralized management system and that community bank responsiveness. But there is a requirement for, hey, we've got expectations to meet. And we need to meet them, and then we need to do it right. You're going to do it legally, and we're going to do it by the book, and we're going to make sure we don't expose our company to undue risk. So we're excited about having Leonard and the team join us. Financially, numbers work extremely well. double-digit mid-teens EPS accretion. It's the most accretive transaction that we've ever done in the history of us doing this. The book value dilution is manageable, earn back acceptable, less than 3 years. And of course, our internal rate of return target's 15%, but this is well over 25%. And then we talked about risk mitigation, but it's diversified across the Southeast. And our balance sheet looks like the Southeast in terms of construct. We're a lot of smaller community banks put together that enjoy scale and efficiency, but business model are very similar. So, Julianne, please, ma'am. We talked a little bit about the transaction metrics, but I put this on there to just kind of give you an indication of the assumptions that we use. We're very reasonable. No revenue synergies when we talk about what we think we can accomplish together in terms of profitability and growth. Cost savings of 30%, which we think are very achievable. In fact, we've done better than that in most all of the acquisitions and transactions that we've done. Conservative credit marks, again, no, but we think there are significant revenue synergies, but we don't model those in terms of pricing. So we talked just a minute ago about what the financial transactions are, but we feel very strongly that the combination, once we get full cost saves in the back half of 2023, that we can create a Southeastern franchise with, again, superior returns, over a 1.3% ROA, greater than an 18% return on tangible common, with a loan to deposit ratio in the mid 60s, with plenty of liquidity to deploy and remix the balance sheet, and exceptional capital levels in terms of 7% TCE, but 9% leverage ratio, and then 17% total risk-based capital. So lots of optionality in a company that we think will be high performing in markets that, arguably are the best in the country. So, Julianne. Well, I want to throw this in. This has a lot of the same, but pro forma, what do we look like? We'll be over an $8 billion company, $8.3 billion as of today. We have a market cap approximately $900 million. And again, we talked about our profitability metrics that we believe we can achieve in our capitalization. But I really want to concentrate, if you look at the chart down at the bottom, what does our franchise look like? And even though we're a bank headquartered in Mississippi, and we serve the highest growth markets in Mississippi, but it's not lost on us. The demographics of Mississippi are not as attractive as some of our other states in the Southeast, let's say. So pro forma for the Heritage Southeast acquisition, Georgia will be the largest segment of our company. Approximately $2 billion, and almost 28% of our market share will be in the state of Georgia. Mississippi will be second, but Florida will be a very close third. So if you look at our company, over 50% of our company will be in Georgia and Florida. Again, exposure to some of the highest growth markets in the country, but then again, fairly evenly distributed market share so that we're not overexposed to any one geographic location. So, Julianne?
And Hoppy, we have about 5 minutes left. I just want to make sure that we get to Q&A. I just wanted to.
Sure. Well, and I'll tell you, I may have lingered a little bit too. I'll tell you what, if we could go to the last page,
sure.
The tangible book value, just the last point I want to make, and I know you're.
Is that this one? I'm sorry.
No, ma'am. It would be page number. I can't see it there. Keep going.
I'm trying to get my find my mouse. Sorry.
No problem.
Just give me a second. I'm sorry. Go ahead and keep talking. Oh, here. Sorry, I lost my mouse. There we go.
Okay. Yeah. So yes, ma'am. Keep going, please, ma'am. Right there.
Here we go.
Back up one page. I'm sorry. No, second to last page. Right there.
Okay.
Talk about shareholder focus. And so I wanted to very quickly point out how we think about these things. And we evaluate the transactions individually in terms of financial metrics, but then we really need to take these two transactions together because this is what we thought about. And at the beginning of the year, we started with a tangible book value of $18.32 well to second quarter. And if you look, by combining these two transactions, Beach had excess TCE. And we thought about it, because of that, it allowed us to be more competitive in the HSBI transaction because we immediately deployed their TCE into the HSB transaction, HSBI. So what did our shareholders give up to accomplish $2.3 billion assets in some of the best markets in the country? Well, about a 1.5% dilution, if you think about it, by the time we get this closed. So the announcements for the individual transactions were higher, but if you look at them together, we think that's a very, very great value proposition. So, Julianne, I apologize for taking a bit long, but
no, everything's good. And actually, sure, we have some questions. First of all, I just wanted to mention in the chat box, there's a link to a one-page summary that's got some pro forma estimates. They're my estimates, but I think they match with the banks. We have a question about your view on M&A, tangible book value dilution, and earn back if you have a line in the sand. And if, yeah, so maybe you can talk about earn back and dilution, and if the current interest rate environment is affecting that.
Well, it is to some degree. Obviously, the AOCI marks are, on paper, reducing the tangible equity, which in all things makes the dilution on a relative basis higher day one. But then at the same time, Julianne, when you model that out, that mark, particularly the way of the construct of the bond portfolio, it's coming back. And right. So there is a real, so it make that you might, and just like in Heritage Southeast, the dilution was a little higher. We like to be mid-single digits. We're no more than mid-single digits initial day one. It was a little higher when we were in the 7% range, but because it primarily affected by the AOCI marks at there, but the income stream was much higher because of the return. So we get the EPS accretion back quicker. So the earn back remains the same, less than 3 years. Okay. So some folks looked at that and went, oh, you're taking 7% tangible book dilution. Well, yeah, but the earnings accretion is 17%. So the earn back still was 2.7 years, right? With or without the AOCI mark.
Right. Let's see. We have another question about if you have any interest in Southern Florida. And along those lines, maybe you can talk about the 10 billion asset mark. You're at eight or so, and so maybe you can just address that.
We don't know much about what I hear about Southern Florida, and I think when you say Southern, you're talking about Miami and closer in that area. It very culturally, I hear it's very different. I'm just not familiar, or we're just not familiar with that market. Now that doesn't matter. We're open to becoming familiar with markets, but I would not say it's one of the top markets because we just don't understand it. I don't think we have enough market knowledge. If we were to find some, comfortable with a company that did, that could change our view. I'm sorry, what was the second part of the question?
Well, it was the 10 billion asset mark.
Oh, yeah.
Where if you see more value staying below that, if you see value going above that.
That's a hard question.
Okay.
Well, no. Hey, we're supposed to have hard questions. I will say this. It's not lost on us that, going above 10 billion creates an entirely different risk, potential risk and return trade-off. One that we need to be prepared for. I guess what I would say is we have always run our bank like we're going to own it forever. We make the decisions that we think to create the most value as if you're going to own it forever. However, I will tell you that we are absolutely shareholders, and everyone that works here, that comes to work here, knows this. We're not out there marketing the bank per se today, but if someone will monetize and give us the value of the franchise that we think we've created, and we think a meaningful premium plus, if we're going to use our assets to invest in a pro forma company, we want to really understand the strategic vision of where that's going. But we absolutely would sell the bank. And there's no bones or secrets about that if we find the right upstream partner. And by the way, we look at that at least twice a year, if not more often. We bring our bankers in to address our board about not only, downstream candidates, but who are the upstream candidates. I will say this, as we approach 10 billion, we do, when we were 5 billion, there was, and again, where our valuations are, there was one set of people who could afford to buy us and who might have interest. And that was a very relatively small group. There were plenty of banks out there, but relative valuation, we traded as good or better than they did. When we approach 10 billion, we think that opens up an entire another set of banks whose multiples are higher than that respective group. So we talk about optionality. We think approaching 10 creates additional optionality. And by the way, we've already started on getting prepared. We changed our regulators to the state of Mississippi and the Federal Reserve just for that reason, because they regulate in our part of the world more $10 billion plus banks. So they've begun to get us ready for that, even though we're slightly over 8.
Okay, well, on that note, we'll have to stop. I'm sorry, there were extra questions. There were additional questions that we didn't get to. We'll start, for all of our attendees, we'll start the Q&A earlier next time. And I'm hoping that we can get these to you.
Yes, ma'am, please. We'll be happy to respond.
And we can try to work out, to get the responses. Thank you so much. Thank you, everyone. Thank you, each of you. Appreciate it. And so, Ian, I'll turn over to you to introduce Flushing and.
Thank you.
Okay, just hold on one moment, please.
We do our transition.
I'm going to pause recording.